This is going to be a analysis on VF Corp's potential upside. Today's date is July 27th, Sunday, 2025. So VFC is a holding company based in the U.S. They own activewear outdoor brands such as Vans, Timberland, and Dickies, and they've been going through a lot of struggles recently. This has been suppressing the stock price, and so the opportunity arises from a contrarian point of view. There's a lot of upside, given three catalysts that I'm going to go over, which are going to drive that upside. So these are the first problems that VFC is facing. First, there's an over-reliance on brand equity. So brands like North Face and Vans, they're relying on their loyal customers to keep buying their product without actually innovating their product, which is kind of, you're stabbing them and relying them to buy like a shitty product, basically. Next, failing DTC channels. Vans especially has had a really sluggish e-com experience. They've failed to update arrivals. They've lacked out on reward points for loyalty, and they've tried to rely on a lot of retailers, which Vans are not really selling in retailers because they've just focused on short-term revenue over long-term brand equity, and they've been selling these pairs on wholesale to cheaper retailers like Softmock and Little Burgundy. Next, they're overexposed in China. China was a little lagging in terms of popularity of Vans. In America, it ticked up in around 2010s to 2016, 2017. Vans really started becoming popular. That's where China, prior to late COVID, popularity started to tick up, and Vans really invested into the Asian markets, which is a really high margin geographics, especially because their pairs are produced in Vietnam, Indonesia, and China. So selling there is very advantageous, but they over-inventoried there, and now Vans not aligning with the Chinese consumer in terms of it's not fitting with their closet, their taste, and their fashion sense. So they're overexposed there. A lot of stock. Next, again, failure to adapt with trends, failing to innovate. With VFC, this comes with Timberland, Dickies, not just Vans. Timberland has been doing well, though, to be fair, because the mainstream fashion is moving toward quiet luxury, and they've just been failing to adapt. Buybacks while top line declines. While your top line revenue declines, this company is still repurchasing shares. Still, even though it's at a low valuation, this doesn't make sense because there are two ways to deliver cash back to your investor. One is through a dividend, and one's through stock performance. And you could kind of accelerate the stock performance by performing buybacks, but it doesn't make sense in this case because you're sacrificing long-term sustainable growth and long-term cash flow to your investor. You're sacrificing that for some short-term stock rallies in a buyback. So it's very short-term thinking, financial mishandle, financial mismanagement. Not a good idea. Next, over leverage. This company has been burdened with debt for a long time, accelerated with their purchase of Supreme in 2020 for around $1.5 billion in 2020. Did not fit with their brand portfolio, and they failed to create synergies as their management team did not have experience managing basically a luxury brand. It didn't fit with outdoor or activewear. So the three catalysts that we're going to be looking forward as kind of indicator if VFC is making progress on its reinvent program are going to be that management overhaul, if it's leaning out its balance sheet, and the Vans turnaround. These two have occurred, and they're continuing to work on to lean out their balance sheet, make themselves more asset light, as well as deleveraging. And the Vans turnaround, we're waiting to see happen, but we're seeing some big steps play out. Next time I'm going to see you, I'm going to talk with the management, and I'm going to be in a fucking Chinese. So the first catalyst is the recent management overhaul of VFC. So the CEO that they appointed in 2023, Bracken Darrell, he was the previous CEO of Logitech, drive a lot of innovation growth and a lot of stock upside. And he also brought Old Spice to men. If you remember all those campaigns where the Chinese or the black dads would argue with their wives that they want the Old Spice soap in their shower, well, that's because of this man. He's also very handsome, and he's spearheading the Reinvent program. So he doesn't know a lot about, apparel itself, but that's regardless. He knows the retail, and he knows product design. He knows what people want, and he knows how to grow sustainably with the retail business and what needs to be done to drive innovation. And his main pillars to accomplish the Reinvent program is one, cost reduction, portfolio optimization, and design. He was really emphasizing design on the Investor Day. On the Investor Day presentation in March 2025, he says that the portfolios have lacked design and innovation, and Vans especially. They keep putting out the same silhouettes. They're sluggish. There's a lot of brand fatigue, and people don't want that anymore. So he's saying a lot of good stuff, and he knows the problems. He knows that an open heart surgery is needed on the company. Next, a CFO was appointed. I'm forgetting this guy's name, but very handsome as well. A CFO of Spotify for numerous years, 8 years. So, Spotify, amazing company, blue chip, and this man knows how to drive growth sustainably. He's not going to make any financial missteps. He's worked for a great company, and you'll notice these two, they had great careers, great companies, and they come into a war zone, right? So they're really here for the passion, you would say, the project, and they're bringing their experience to really turn this boat around. Next, we have Venkatesh, not sure what his name is, but he was appointed COO in 2024. He's leading a lot of cost and efficiency. He was recently he was an MD at BCG and an SVP at Lululemon. Lululemon, again, over the past decade, great performance, kept putting out great products, incredible financial health. It was run very nicely, so he's bringing his experience to VFC. Great pick. Next, we have Sunny Cho, I think, or Cho Sun. She was a previous chief product designer at Lululemon. Again, they put out great products, really at the top tier in terms of athletic wear. For a long time, they still are, and they positioned themselves nicely to take control of the new trend, which is athletic wear, fitness, and what people want today and what people are wearing. People aren't necessarily wearing the active wear anymore, the Timberland, the skate culture. They're wearing comfort and activewear. That's why Hoka, On, Saucony, Brooks, Lululemon, Gymshark, these companies are taking over now, and she's here to pivot, maybe aligning the Vans with that new move, and just repositioning the brand portfolios to align with consumer trends. And irrelevant catalyst, but it's always nice to hear. Her hire saw an 8% gain, stock gain on news. Short term, doesn't matter, but nice to see that investors want here. So some commonalities, again, these are all high profile picks that had great careers elsewhere, right? And they really came for the passion, the project, and really to drive a lot of cost discipline across the board. And these are seasoned veterans as well with a lot of experience, and this will prove really beneficial to VFC in clearing a lot of those internal problems. All right, so let's go over the second catalyst of how VFC is going to turn around. So the second catalyst is actually leaning out their balance sheet. So what this means is that they're going to be deleveraging, becoming more asset light, getting rid of underperforming brands in their portfolio, and just becoming more profitable as a whole. So first step of them doing this is optimizing their brand portfolio. As I talked about previously, they purchased Supreme for $2.1 billion in 2020. This was when, during COVID, when Kering, LVMH, all the luxury houses were performing incredibly. During COVID, people were getting a lot of payments, CERB checks, a lot of money, and they spent on discretionary items. This is when luxury stocks just boomed. And since then, post-COVID, luxury has done very poorly. And Supreme never really made sense from a portfolio stand of view because their management never really had experience or expertise in the luxury markets or even serving Supreme's target. They're much more fitted towards the outdoor activewear brands, so like Vans, Timberlands, North Face. Those are their three main brands that they rely on for top line growth. So Supreme never really made sense. It took a loss on that. They sold it for $1.5 billion in 2024, and they paid off a lot of debt using that. So that purchase was leveraged for around $2.1 billion. Took out a lot of debt. At 1.5, paid off some of that debt. Again, never really made sense from the beginning, but at least they're cutting their losses there because it never really made sense from a portfolio stand of view. Next, they're performing a dividend cut, or they've already performed a dividend cut. The dividend never really made sense because, well, while revenues were declining, they were basically focusing on making short-term investors happy, and they're really sacrificing long-term gains for short-term content. And they cut it from $2 per annum in 2021 to less than a cent in 2025. So pretty insane. Sorry, 9 cents. Yes, this is great because it saves a lot of cash for the business that they can then use to further deleverage their business, and they're prioritizing long-term equity value rather than making short-term investors happy with the dividend. So more cash is always better. Okay, next is the big one. They're deleveraging. So a big one, they paid $750 million of its 2.4% senior notes maturing in April 2025 at par. So all this means is that they had a big note payment and they're maturing it, or they're retiring it a little early. It shows that they have available liquidity to do so, and they're able to refinance it at a lower rate. So it's always great to hear. Next, CEO Bracken Darrell reaffirmed his goal to achieve $300 million in cost savings by 2025. He's set to do this annually, so he wants to achieve $300 million in cost savings every year. Great goal, and I think if he does do this, this will be great for becoming more profitable in the future. Next, we're going to be doing a lot more inventory discipline. In 2020, in COVID, they got very cocky with their retail endeavors. They sold a lot of inventory, which there really was no demand for, especially in the Asian geographics, where demand slowly ticked off as Vans started rotating out of people's closets and people's tastes. So what happened was Vans and the shoe items like Timberlands were just significantly overstocked and marked down significantly, which harmed their brand reputation, their brand image. So since then, the long-term brand equity value has fallen. So they're going to be using a lot more SKU rationalization, by using variations like the sizes, the colors, and silhouettes of the shoes to anticipate what will sell and what don't sell. And also using geographics a little bit better as well. So we'll be using predictive AI to do so. As I said, VFC has really fallen the curve in terms of their digital transformation. So using predictive AI in terms of inventory is a great step forward, but more steps need to be shown. Now let's take a look at their balance sheet to see if they're actually deleveraging and becoming more asset light. So the main thing you want to look at is the liability section, but not so much the current liabilities. The short-term payables are much more used for financing day-to-day operations, equipment, orders, deferred revenue, that type of things. What you want to look for is the long-term liabilities. These notes and these debts are mostly used for acquisitions, paying a lot of capex, financing, and these are the types of liabilities that really burden a company like VFC, as the payment date for these are a lot longer in the future, and to refinance them, it's going to be a lot more expensive as you don't know what the rate environment is. So those ones are the ones that really hurt VFC. You can see here long-term debt down $1 billion since last year, which is incredible. We're making great progress. And we want to look out for, yes, the current portion of long-term debt down $500 million. This is in thousands. So they're making great steps forward. To stockholders' equity, it is down, but that's fine. We're becoming more profitable, even though our equity value is decreasing. Again, we're selling assets like Supreme and so on to become more profitable, and we're consolidating the business. So that is it for how VFC is leaning out the balance sheet. And we'll pivot to the Vans turnaround next. All right, moving on to the last catalyst that will confirm the VFC turnaround will be whether or not they can turn around the Vans brand. So let's begin with why Vans has been on a recent slump. So it mainly starts off with interest. Vans has rotated out of the Gen Z closet, hasn't really aligned with fashion trends. And we can see this by the Google kind of like search interest over time. A little bit glitchy here, but we can see 2010s to 2016 really popping. This was when the white girls were lacing up their old schools with their skinny jeans, and it's kind of ticked down, pulled back since then. As I said, it's just kind of it's just become out of style. You don't really see it so often now, especially among 20-year-olds. We're seeing a lot more athletic wear focus, right, and a lot of comfort. So we're seeing people walk around with the Hokas, Ons, the Asics, even the New Balances, the dad shoes. So the skateboarding punk culture as a lifestyle sneaker hasn't really attracted a lot of audiences in recent times. In addition, Vans has actually disinterested its loyal audience, and it's actually the skateboarding audience, which is supposed to be its most loyal customer base. They've kind of lacked out on quality, and its loyal customers have noticed that. They removed the loyalty program, its point programs as well, which has been a reason why its DTC channel has failed recently. They're not converting a lot of sales to their own website, in which they've resulted to wholesaling sneakers to cheaper retailers, and that has had detrimental impacts to its brand image, and I'll get into that later. And secondly, the main reason why Vans turnaround will be so impactful to VF's net income and top line is because the other two brands, Timberland and North Face, their top line's growing, and Vans is falling recorded 22% drop in revenue, and it's falling year over year. If it even breaks even or reduces the net loss, VF's revenue, instead of falling 5% year over year, which it has been because of Vans, will actually see a net income instead. In addition, Vans has been closing a lot of stores. They closed the largest, or the main store in Toronto, the one on Yonge Street, as well as the second largest store in San Francisco store within a year. This is bad sentiment, really negative sentiment, but on the bright side, they are consolidating their underperforming stores, their high-cost stores. They're focusing on the more higher marginal stores and better geographics. So when it makes sense, again, they just want to really be cost efficient and maximize profits given the distressed time that they're in. So the first key driver that will dictate if the Vans turnaround is being successful is, again, product prioritization. People are sick of the same silhouettes with different colors, and Vans is really going to have to focus on what sells and optimizing their inventory using stock keeping units rationalization and going back to quality as well. Bracken has really said that he needs to focus on design and innovation, and this is something that he's learned with his tenure in his prior companies. And next, Vans cannot be cocky. It cannot be overstocked in cheaper retailers, and they have to anticipate trends and forecast them correctly. Vans is overstocked in a lot of Asian geographics. That's why they've done poorly, and that's been the reason for their decline in revenue. And they have oversaturated the market with their products. You can see it in Soft Mock, Little Burgundy, on a whole run through these cheap retailers where you don't want to walk by these retailers and see Vans everywhere discounted on price. It doesn't do great for the brand image. and it's really diluted its cool factor. So Vans really has to get back its cool factor by cleaning up these retail channels and focusing on their online website. So let's look at their cult marketing strategy that I think will do wonders for Vans. Okay.
If Drake, I'll say this way, if Drake or a high influential celebrity, Kendall Jenner, Justin Bieber, wears a product, let's say Vans for example. How influential is that going to be? Well, very influential. But to what audience? It's going to be a mass audience. And Justin Bieber and these people, they have fans, no doubt. But do they have a cult-like following where they'll just... What I'm trying to say is that they have too big of a following for anyone to really... for these fans to form a cult almost.
So by Vans targeting kind of smaller creators, a little bit more underground with a cult following, fans that will kind of splurge and buy anything, and those that are a little more underground is a much more successful marketing strategy going forward. Because going for the top guys too quickly is not how you do it. For people like me, if I follow an influencer that has 30, 40, 50K on Instagram, I'm going to be more inclined to wear what they're going to wear or be more influenced by their style choices relative to someone with like a Drake or Justin Bieber who has hundreds of millions of followers. And me, I'm thinking, well, if they're wearing this, then everyone else is going to catch on, right? And I don't want to be like that. I want to try to, find something that not everyone's going to have, but still influenced by these guys. Not to say that, these guys are wearing it, I'm going to start wearing it. But we have people like Young Thug, who, to be fair, is a bigger creator, but he was a little later to game in terms of Vans pushing it. So you have guys like Netspin wearing Vans, Lil Uzi, Salon, the UK, love him. So much more. Matthias Golan, Ass Pizza, Anthony Asfor, Justin Saunders. And this is going into more of the collab areas. But you have people like Joe Vaca, who's based in Montreal. He's been essentially putting these small creators on Vans, giving them Vans, right? And targeting the influence of smaller creators and their cult following is a much better moat to preserve a brand quality and the brand image because of how distressed Vans' image currently is. So again, they've collaborated with FTP, Valentino, Hysteric Glamour, Matthias Golan, Gallery Department, Jown, Punkinyo, and Undercover. So these are just a couple in recent times. They've still come out with more, and something that they need to do is focus on their legacy collaborators. These are like Dime, Supreme as well. So bringing back these legacy collaborators, which they've had successful collaborations with, will prove very successful for them. So that's kind of like the cult marketing strategy that will perform well. And I'm going to show you an example. It's similar to the Samba example here. So let's take a case study of the Adidas Sambas and how this proved successful. So the Adidas Samba, it started as a futsal shoe around like the 80s, I think. And then, it kind of stayed being a soccer shoe. In British culture in the 80s, it became kind of the hooligan shoe. And then now in recent times, likes of Kendall Jenner, other celebrities, they started wearing them, popularity explode. But the thing I want to focus on is the transformation of mass use case. So previously a soccer shoe, now a luxury shoe. Vans, it was a skateboarding shoe, now it's a lifestyle shoe. Since then, it's kind of voted out of fashion. If it was in it, I think it could always come back, right? And something about Vans that's similar is with the Sambas and other shoes that always pop in and pop out are its simplicity, wearability, and also its affordable price point, right? Vans at the most are going to be like $100, right? Super, super, super cheap. And I think with their newer models, again, this is doing too much. You're trying to align with the Speedmaster a little too much. This is just a direct copy. But they're going for the slimmer silhouettes, and they're offering a little bit more on the table, except rather than just the same old slip-ons or the old schools. So I like this approach. You're doing something different.
You're innovating. But as I said, you don't want to wear something that, let's say Drake, or like a massive celebrity is wearing it. You want to wear something that a smaller influencer, a smaller creator is wearing, smaller audience, and you want to be part of that smaller audience. You want to be part of something personable, cult-like, and everyone's chasing that uniqueness. And being 1 in a million, the system that Drake's wearing, etc., is not going to go well. And Vans is doing that approach very nicely with their collaborators and the people that they've managed to put on. So this is more or less a passion of Vans. As you can see, I'm wearing some right now, of course, the LX issues. And I think this can advance turn us, especially on Bullish on. I think they can definitely turn this around. Going into 2025, 2026, going into 2026, these collaborations will continue to happen. I'm seeing a lot more smaller brands with a cult following collaborate with Vans, bring people on Vans, and the right people are starting to wear Vans, which we want to see.
So yes, I think upside is there for Vans. I'll put a price target on $30 for it for now. We'll see what happens. But yes, those are my 3 catalysts for Vans. Sorry, for VF Corp, but mostly Vans, why I can turn around Vans. And yeah, very bullish. All right, I'll see you. Love. Thank you for listening.